start.
Good. I'm happy with that.
Okay, gang, what we want to do is do financing activities, ratios, and then look over the specifics of your assignment, and then turn you loose, I guess. So financing activities in the assignment, for an example, is not too bad. Let's see what I do there.
Well, I'm trying to figure out how I can get some of these copied over to mine, but I can do it too. Like, you mean you have it in you then?
That's not actually my last one. That's the extra one.
Oh.
There's a lot more than that.
We had only one graduate.
Really?
No, one dropped
Well, there's two of us who were really important.
and one graduated.
Right. Yeah,
She started. I know. Me too. Like, one down, 5 to go for me. That's what I keep saying.
Which is kind of ironic. Yeah, 18 years.
Put one down. Like, you get through one, you get through another one. Then you get
My
through.
friend says, you know,
I tried several things and didn't get.
Bipolar.
it's something
I tried clicking on it, dragging it. I
It's
couldn't.
It's probably
From work, it's
60 to 70% technical, and
Okay,
30 to 40% sales.
Okay, gang.
There's a lot
like
of
people
technical
though.
stuff, so
You
yeah.
can talk each other through this.
It's pretty cool until your pager goes off to 2 in the morning.
Isn't that depressing? So then you don't feel refreshing though.
Okay, with financing activities, basically this is common stock and long-term debt. There's typically not a lot of action here. Your most common kind of long-term debt will be either a note payable or a bond payable. And here's what typically happens. We had, in the Robbins example here, when we talked about the purchase of the land, we had the $20,000 increase in long-term liabilities. So that would be to issue new debt, or we may retire old or existing debt. And typically, when new debt is issued, that'll be a source of cash. And when old debt is retired, that'll be cash paid or cash going out. Common stock, the same idea. You might issue new stock. You might retire old stock. Now, I'm showing you here a single account. You may also check and see. It's one detail on that. Let's go ahead and pass this tab. This is the information for Bauer. It's the income statement, beginning and ending balance sheets. Yeah, your Bauer one has par value, additional paid in capital. That actually makes the analysis easier. So what happens? This all depends on the rules of the state where the corporation is chartered. Some states require stock to have a par value or a stated value. So here's what happens. If you issue stock for $50 a share, if it's in a state that doesn't require a par or stated value, the entire $50 goes in the common stock account. If it's a state that requires a par value or a stated value, and let's just say that that is $5 a share, what happens is you have to put $5 in this account and the other $45 down here. So that's the only difference. And this is helpful because once you know the par value, you can tell how many shares are in play here by dividing the dollar amount by the par value. So the Robbins example, she just has a capital stock account, whereas the Bauer assignment that you guys are going to do, it has a par value and an additional paid in capital account. So that's the only difference there. Now you may, not on either of these assignments, in owner's equity, you may run into an account titled treasury stock. Treasury stock is going to have a debit balance. Okay, with treasury stock, what happens if you buy back stock and just want to get rid of it? You debit the common stock account, and that basically just decreases the amount of stock that's there. But what if instead you bought back stock with the idea that you might reissue it someday? So if you might reissue it someday, you don't want to retire the stock. You want to hang on to it, so you put it in this account called treasury stock, and it sits there until you turn around and you reissue it later. What typically goes on with treasury stock is this. A lot of companies will have stock option plans. So if your company has a stock option plan, you have the option to do what? Buy shares of stock. Well, what if the company doesn't want to issue any more brand new shares. Where are they going to get the shares then to give you when you exercise your stock options if they don't want to issue any new shares? They have to do what? Go out in the open market, buy back some shares so that they go out buy them, then they reissue them to you as part of the stock option program. Now you said, why would a company do that? Why would they go out in the open market, buy back shares of their own stock so they could turn around and reissue them, especially when they could issue brand new shares? Why do you think they might do that? Because of the dividend. It's considered a negative if a company ever cuts its dividend rate. So, if a company's paying $2 a share dividend per year, if they issue 1 million new shares of stock, what is that required to do each year? Come up with $2 a share, 1 million new shares, that's 2 million more a year in cash to pay out in dividends. So what the companies are thinking is, as we increase the number of shares outstanding, if we don't want to cut our dividend rate, then we have to increase the amount of cash we pay out each year. So that's typically why companies are hesitant to issue new shares of stock. It's a new cash flow requirement for the dividend. That brings us to the last account here. We also have to take a look at retained earnings. Okay, dividends. When a company pays dividends, this is part of financing activities. So cash paid for dividends has to always be also included on the cash flow statement. So dividend retained earnings, beginning balance, income increases it, dividends decrease, then you get to the ending balance. There's typically not a lot of activity in financing activities, but there's always a little bit of fun stuff there. So let's go back to our Robbins example. On your solution, financing activities is really, about the middle part here, page 4. Not a lot going on there. So, look at there's only one long-term liability for Robin, and that is notes payable. And we already explained where the $20,000 increase in notes payable came from. That was when the land was purchased, and we borrowed $20,000 from the seller. So there's no cash involved there. Now look at the capital stock account. It goes from 100 all the way up to 200. And look at additional information, item number 6. Down at the bottom of the balance sheet. Capital stock was issued for $100,000 cash. and that'll be a cash flow item. Then, go take a look at retained earnings. It goes from 193 to 250. Okay, let's plug in net income, which was 95,000. Now, add 93 and 95 together, we get what, 288,000, but we've only got 250,000, so that's a difference of 38. That's dividends, and let's compare that with item number 7, additional information. It says dividends of $38,000 were paid, so that fits. So this right here, those are our two financing activity items. So cash received in the stock issue is 100,000. Cash paid for dividends is 38. So cash flow from financing activities would be a positive $62,000. Now, look what you've got right there smack in the middle of page 4. It's a summary then of all 3 sections of the cash flow statement. Okay, go back to the beginning balance sheet for Robin there, and cash begins the year at 110. So, when we did operating activities, we had 128,000. And then earlier this afternoon, we did investing activities. Was a negative 170, and then we just did financing. 62. That all nets to 130. And if you take a look at the ending cash balance, it is 130. So that reconciles everything that we did. So, investing and financing are simpler than the operating section. And then you put it all together like that. So the last piece of the puzzle then is ratios. And we'll come back to Robin to look at these in a minute. And there's more ratios out there than you can shake a stick at. Pretty much, if you take any number at random from a financial statement, put a numerator, and the other number at random in the denominator, somebody has a name for that ratio. But we're not going to look at all of those. To which you all say, yay.
Yay.
Very good. Okay, sort of our ongoing theme throughout all of this has been that the key to good financial statement analysis is understanding how the parts fit together. So a ratio is going to do that. The numbers in the ratio, what you put in the numerator and the denominator, should relate to each other. Not every ratio, but most of the ratios have a cause-effect relationship like this. Consider, for example, return on investment. Income divided by assets. Okay. The more assets you have, the more income you ought to be able to generate, right? So, you two are both division managers. And I give you a division with 5 times the assets that I give you. Well, would it be if I'm going to evaluate you two in performance, and I'm just looking at income in isolation, you want to have less income than her, all other things being equal, because your division has 1/5 the assets of her division. So, since she's been entrusted with more assets, she ought to be able to generate more income. So, that's what any good ratio is going to do. These numbers ought to fit together in a meaningful way, such that understanding the two in relation is more powerful, more enlightening, than understanding the two by themselves. A metric? Yes, it is. Sometimes they're even symmetrical. That's much more rare. So the first ratio we want to look at, something called the DuPont formula. Some people like to call it return on assets. Some people like to call it return on investment. It's the same idea, whichever name you give it. Now here's what DuPont did. Basically, DuPont took return on assets and broke it down into 2 components, asset turnover and return on sales. See, since sales is here and here, you cancel those out. and you get on the left and the right the same thing. Now, here's the idea. It's right here. That sort of looks at the question, how busy is the business? Over here, how efficient is the business? So, if your return on assets is too low, it's lower than your business historically or lower than the averages for your industry, you've got something wrong and you want to set about trying to fix that. Well, one possible explanation for this number being not what it should be is we're not moving enough product out the door. So if you've got a business, a factory building, if you're only running one shift today, if you put on a second shift, that ought to do what? Double your asset turnover. So, if the asset turnover is too low, a lot of times this can point to some sort of a external explanation. Why aren't we moving enough product out the door? So if you want to use the marketing mix as a guiding metaphor here, price. Is our product priced right? Promotion. People know about it? What about the product itself? Does it have the attributes that people want? Distribution, is it out there for folks to buy? So that's sort of one road we can lead down, looking for explanations or reasons why this might be too low. Now over here, note that income is equal to sales revenue minus expenses. So, for any given level of sales, how do you improve return on sales? You have to cut expenses. So, how do you cut expenses? Are you operating as efficiently as what you could be? Is your waste or your scrap too high? Are you lean enough in your operations? Things like that. So this is sort of looking at our product, and is the product what the market wants? And are we getting the product out there in a way that maximizes the market's reception to it? This is sort of an internal explanation. Are we running our operation as efficiently as we should? So whether you call that 1 ratio or 3, that is a very useful way to look at any organization. So that's our first set of ratios. Then we got one more set here. This next set is trying to answer this question. How long does it take our organization to go from cash to cash? So we're going to look at 3 turnover ratios. Okay, the first of those is accounts receivable turnover. And that'd be sales revenue divided by average accounts receivable. What we're looking at here is how quickly do your customers pay. So if your terms are, say, net 30, you would expect your customers to pay their bills in about 30 days. How many 30-day periods are there in a year? About 12. So you'd expect your turnover number here to be about 12. Now, a related ratio to this something called average days to collect. And you take the accounts receivable turnover here. And you just divide it into 365. Okay, so this is getting our customers to pay us. They're not going to pay us until they actually buy the stuff. So another interesting ratio to look at is inventory turnover. On average, how long is the stuff sitting on our shelves before somebody comes to buy it? Okay, COGS, COGS, that's my abbreviation for cost of goods sold. So you got cost of goods sold divided by average inventory. And same idea as up here. You can convert this into something called average days to sell. So 365 divided by inventory turnover. Like so. Then, so these two involve the business waiting on other people. Waiting on the customer to come in to buy, waiting on the customer to pay. The third ratio involves someone else waiting on the business. And that third ratio there is accounts payable turnover. So basically, this is how long we are using our suppliers to finance what we owe them, and that is purchases divided by average accounts payable. And you can do the same thing over here then. And take 365, divide it by accounts payable turnover, and get average days to pay. There we go. So those three ratios, the three turnover ratios, help us get an estimate. How many days does it take our business to go from cash to cash? And when you get all done with these, here's what you can do. You can sum them together, something like that. You add together average days to collect and average days to sell, because this is us waiting on other people, and then you subtract out average days to pay, that's other people waiting on us, and then the net of those three is average days cash to cash. So that's one measure. If you could shave that down, you're improving the efficiency of your operation. So let's go look at Robin's information here and compute those ratios for good old Robin. Okay, the DuPont formula, let's do that first for Robin. Okay, so Robin here had income $95,000. Then average assets. Go to the balance sheet for Robin. She begins the year with $740. Ends the year with $930. Add those two together, divide by 2. 190 is the difference. 95. $95,000 divided by 835,000 is 11.38%. Asset turnover is sales, 700,000. Divided by average assets. Since we already know average is 835, no sense of writing all of that out. And that is 0.83 times. And and then return on sales, 95,000 divided by 700,000. And that is 13.57%. See, if you're in a high turnover business, if you've got a return on sales of 1%, but your asset turnover is 15 times, your return on assets is going to be 15%. So the higher your turnover, that turnover of your assets, that magnifies your return on sales to get a higher return on assets. So if you've got a high return on sales, a lower turnover still gets you an acceptable return on assets. So that's the DuPont formula, again, for Robbins. You guys will do that for Bauer. Okay, let's see here. Yes, bottom of page 4 still. Inventory turnover is what I did first there. So for inventory, the turnover, the numerator is going to be cost of goods sold, which is 500,000. Divide that by average inventory, which is 215 plus 225. So 500 divided by 220 is 2.27 times. Then you take 365 divide 2.27 into that, and 160.6 days. So on average, our stuff sits on the shelf 161 days before somebody comes in to buy it. Okay, page 5 of the solution. Accounts payable turnover. Okay, the numerator for accounts payable is purchases. So you go back here to operating activities, and we found out that purchases were 510. See, this is cost of goods sold. This is purchases. Then accounts payable. Let's see here. Beginning of 50, ending of 60. That's an average of 55,000, so 510 divided by 55,000 is 9.27 times
accounts payable turnover starts with the cost of goods sold.
No, that, no, it doesn't. It starts with purchases.
Oh. Okay, that's where I was getting,
And you see that, because if you look there in the solution, what's the numerator in accounts payable turnover?
okay.
Top 510. And at the bottom of page 4, the numerator in inventory turnover is cost of goods sold. And we got the 510. The 510 is not on any income statement, but back there on page, yeah, what is it, page 1 of the solution at the bottom, we analyzed and we got purchases of 510.
Oh,
Okay, now here's why. You may think, why purchases for one, cost of goods sold for the others? Because what fits best? What happens when we sell inventory? We have cost of goods sold. What do we have to pay our supplier? Why do we have to pay our suppliers? Because we purchase stuff. So purchases relates best with accounts payable. Cost of goods sold relates best with inventory.
got it.
So that's why we do it that way. Not just to be aggravating, that's just sort of an unavoidable, side consequence. So that works out to be 39 days. And then last but not least, accounts receivable turnover. And that's sales is the numerator. That's the 700. Accounts receivable is 120 plus the 130. So that's 5.6 times. And that works out to be 65 days. Now what happens you end up with, well, let's just erase it. Okay, it's the very bottom there, page 5. Average days to sell. Is the 160 minus 6. Average days to collect. Is the 65.2. And then average days to pay is the 39.4. But be sure to treat the average days to pay as an opposite, as a negative, because these two, remember, we're waiting on other folks. This is other folks waiting on us. So average days cash to cash for Robin is 186.4. So there's more ratios than that out there. But for you guys, that's enough. So assignment number 2, you're going to use the Bauer information. And assignment number 2, you will submit investing activity cash flow, financing activity cash flow, and those ratios here. So when you read the book, let's see here. Yeah, the book that goes with this, Siciliano's Finance for Non-Financial Managers. He talks about more ratios than this. These are all you have to cover. And again, follow the format for Robin. So what are the due dates? Yeah, January 4th and January 25th are the 2 due dates. And like I say, we're recording all this stuff. It'll be out on Blackboard. You'll be able to email me with questions. But I just think that the longer you let the stuff set between now and when you eventually start to work on it, I think it's not going to be as fresh. So now, before we let you go here, I couldn't make Bauer identical to Robin. If I did, it's more an exercise in dictation. Okay? So there have to be a couple little interesting things. Take a look at accounts receivable. You also have something called allowance for uncollectible accounts. Here's what I would do. I would create something called net accounts receivable. And what am I netting there? I'm netting accounts receivable with the allowance. And so now, put aside Robin, take a look at Bauer. Your beginning balance then would be the $418,000 in accounts receivable plus the $18,000 in the allowance. Your ending balance is going to be the 470 less than 20. You still have sales of some sort. Now, under the allowance method, when you write off an account, you debit the allowance and you credit accounts receivable. Okay? What happens when we combine the allowance and accounts receivable together? Then you end up, when you combine the two together, your debit and credit offset, don't they? So you don't need to worry about write-offs. But look, you have something in the income statement. You have an expense called bad debt expense. That adjusting entry for bad debt expense is a debit to the expense account, and it's a credit to the allowance account. But you see, we've combined them both together. So, you're going to find, I just can't bring myself to write this number and this number in here, because then I've set the whole thing up for you, just solve for that, so I'm not going to actually do that, okay? But anyway, now, if I had said nothing here when all Sergeant Schultz and you know, when Colonel Klink asked him, Schultz never knew anything, stayed out of trouble that way. I could have done that. And as an MBA student, to expect you to go dig out your accounting book from your undergrad course, or that fount of knowledge, the Ivy software, or Google. But I think this will help speed things. Now, one other thing now. What do you see down there underneath merchandise inventory? Short-term notes receivable goes from 50 to 100. Well, I know I gave you
I know.
dog. I don't have any spares.
I have an extra.
You
Like,
do?
I had to swap out.
Thank you. So you have to wash your car when the weather gets nice.
Brush the snow off.
And you can do that this afternoon. You guys work that out. Maybe you end up cleaning your house. I don't know. You know, whatever, between two consenting MBA students. Don't ask, don't tell. Where do you think that increase in short-term notes receivable came from? Why would I make someone's, I mean, I could be in the business of loaning money, because that's what a note receivable is. But you know what that probably is? That's probably a sale where the customer wanted a little more time to pay. So, your sales revenue of $195,000, $50,000 of it is going to be used to explain the increase in the short-term notes receivable. Which means up here, you're only going to include the remaining $145,000. If $50,000 of it is used to explain the increase in short-term notes receivable from 50 to 100, and you've only got $195,000 in sales revenue to begin with, that means you've only got $145,000 left to include up here. Got that? As much as you can get it. About 450 more on Saturday afternoon. Okay, so that's a little different, but in a fun way. Go down underneath bonds payable. What do you see underneath there? No, what account? Discount on bonds payable. if you want to know where discount on bonds payable comes from, Google it or send me a private email, but we're not going into that at 4:52 this afternoon. Okay, bonds payable has a credit balance of 500. Discounted bonds payable, it's got brackets around it, it's in the liability section, so that means it has a debit balance. So discounted bonds payable goes from 10 down to 5. That discount on bonds payable represents additional, and it's part of interest expense, put it that way. So on the income statement, interest expense is $10,000. So if interest expense is $10,000, and $5,000 of that came from amortizing the discount, how much is cash paid for interest? Okay. Listen to Drew.
Is that a rhetorical question?
No, as I said, listen.
Okay.
I don't want to
I'm
give,
just so glad I was.
I don't want to give the answer, so I'm saying, listen to the wisdom of your classmate. Okay? So, those are a couple extra hints you might find useful. And with that, fully, according to my watch, 5 minutes and 45 seconds early, we're done. So, Merry Christmas, Happy New Year, all of that stuff. We will reconvene in February for the second half of the course. But, before we leave, are you guys as clear as you can possibly be at this juncture in your studies about what you're going to do between now and when we get together in early February? You've got 2 financial statement analysis assignments.
One of them to do before break.
Yeah,
No, it's not due before.
it is not due to the 4th of January, but you know, I mean, if you know, this next coming week, you had a chance to knock that one out, that would probably serve you well.
Isn't it the 11th?
Did we change the date on that to the 11th?
Looks like the 11th or the 25th.
Yeah. I wasn't sure if I remember, because when I got the original schedule, they didn't have the Christmas break in there. So I went in and said, yeah, whatever that says, it says the 11th. Still, you've got all this next week here before merriment, you know, sets in earnest, or maybe it sets in early in
Will they be sending out information about these little chat sessions?
They better, because I don't know either. Here's what I understand. I think they're going to have to add something to the Blackboard shells, and then it's going to be I guess, the way Wendy explained it, you guys all phone in, and I phone in, and it's like a big old conference call. These chat session things.
January 8th and January 22nd.
Did that where I was at.
Chat
Live
session.
in class.
Yeah, so
We can
What?
see the professor.
I don't think there's going to be a camera involved. I think, Wendy, is it just all audio, these chat
Via the
things?
computer.
Huh?
via the
Right,
computer.
But they're not going to have a camera where they can see me or
No,
anything.
nope.
So it's not quite that. It's just audio, so you don't have to dress up or anything.
Well-
And I don't have to either.